One of the first things we look at in managerial accounting is how much did it cost us to make our things. So we're trying to figure out what our cost of goods sold is in any period of time. First thing we do is break up our costs into product costs, costs that we want included in our cost of making our things, and period costs, things like sales commissions, rent on the showroom building, anything that's not related directly or indirectly to the manufacturing process. The other costs are called product costs, and they're going to flow through our T accounts. Direct materials, these are materials that are substantial and easily tracked and traceable to our products. Direct labor, I put payable after that because we pay our people at the end of the period instead of up front. And these are direct labor costs where our laborers work directly on our manufacturing process. And manufacturing overhead, all the other indirect costs or direct costs that we can't really track, like little tiny nails or brads that go into our product. We're not going to track each individual one. We're going to lump them into manufacturing overhead and apply them. Which brings us to the question of how do we apply overhead? We have to have rules. In this super simple example that I created, we're going to assume that we sit down at the beginning of the year and decide that we're going to have about $100,000 in manufacturing overhead during the year. And we think that a good cost driver for applying those overhead costs is direct labor hours. So maybe this is some kind of labor intensive business like making dining room tables. So we form a ratio, $100,000 worth of overhead costs estimated for the year divided by 1,000 direct labor hours estimated for the year means that our overhead application rate, our rule, is going to be $100 per direct labor hour. So let's run through these facts and see if we can figure out how much it costs us to make each of these dining room tables. So the first thing we do is we buy $100,000 worth of direct materials. Direct materials is an inventory account. Inventory accounts increase with debits, so we debit direct materials. Accounting books often use accounts payable. Let's use cash and pretend like we pay for everything in cash to keep it simple. And these accounts down here really don't have anything to do with our cost of goods sold, but to make those of you comfortable who need to see a debit for every credit and a credit for every debit, we'll put those down there. Workers work 40 hours in the factory at $50 an hour. That's $2,000 that we owe our laborers. And since they're working on our products, we know that that goes right into work in process. So these are the things we're going to work on, these are the things we are working on, and these are the things that are finished. Then we buy more direct materials for $50,000. Direct materials is an inventory account. Inventory is an asset which increases with debits. That's, again, to keep it simple, let's assume that we are paying cash. Then our workers work another 40 hours. We look at their time cards. We see that they work another 40 hours. So that's another $2,000. We put that into work in process. Then we pay rent on the factory. Well, we want that to be part of our product cost, but how much of the rent goes into each individual dining room table, we don't know. So we'll stick it, in the meantime, into manufacturing overhead. Then we pay the utility bill for the factory. Same logic here. How much of each utility bill goes into each dining room table, who knows? But let's stick it into manufacturing overhead in the meantime. Lubricant and oil, same concept. So we're going to stick that into manufacturing overhead, and let's assume that we pay cash for it. Okay. Then we move $100,000 of direct materials into work in process. In other words, we look at our records from our guy that manages the warehouse, and he says that our workers checked out $100,000 worth of wood and metal and whatever other materials they need to make our dining room tables. So we take that out of direct materials and move it into work in process. Then we pay our workers. We always have to pay our workers. So how are we going to pay them? We'll pay them with cash. And then manufacturing overhead is moved to work in process at the rate of $100 per direct labor hour. Well, our guys worked 40 hours plus 40 hours, that's 80 hours. 80 hours times $100 per hour is $8,000. So we're going to take $8,000 out of manufacturing overhead and move it into work in process. So now we have in work in process our labor, direct labor, our materials, direct materials, and our manufacturing overhead. During the month, let's pretend like everything got finished, so all 112 units got done. Let's assume we make 112 dining room tables. So we'll take all $112,000 out of this account, work in process, and move it into finished goods. Once it moves into finished goods, it doesn't accumulate any more costs. Then this simple problem tells us that we sell 100 units for $150,000. So let's first book the sale. Let's debit cash for $150,000 and credit sales for $150,000. Now we have to assume we're in the perpetual inventory system, move 100 units out of finished goods into cost of goods sold. Well, if it costs us $112,000 to make 112 tables, that's $1,000 a table. So let's take, since we sold 100 of these things, let's take $100,000 out of finished goods and move it into cost of goods sold. So we take all our costs from the left-hand side T accounts and move them across to the right-hand side. Let's create a little mini income statement down here. Our sales are the $150,000. Our cost of goods sold is that $100,000. 150 minus 100 gives us a gross profit of $50,000. So, like I say, one of the first things we want to do in cost accounting is to figure out how much it costs us to make our stuff. It's an important part of managerial accounting. So we're going to take our costs from the left-hand T accounts and move them across into the cost of goods sold. Start out with direct materials, direct labor, payable, and manufacturing overhead. And the only hard part is figuring out a rule for that manufacturing overhead. So hopefully this will help you understand the flow of costs in a manufacturing environment.